Hello all. Today we're going to start our new section, Part 5, Firm Behavior in the Organization of Industry. This section is going to introduce two main concepts. First off, we're going to explain cost and the cost firms face in order to determine how much they supply. And then from there, we're going to explore how different organization of industries, i.e. how many firms are industries, how many buyers and price making influences and affects firms' ability to reduce according to cost. So with that, we're going to hop right into it. Now, apologies here, you should be seeing a slide. This is chapter 13, production costs facing firms. What are costs? Well, ultimately, let's consider for a moment what we're interested in. Ultimately, we know that all firms are interested in profit. To get profit, we first have to consider total revenue, i.e. the amount a firm receives for the sale of its output. So basically, total revenue is the amount of money that a firm receives from selling its goods and services. And we can find total revenue by multiplying the price times the quantity of goods sold. So simply put, how much money does Coca-Cola make? Well, the price of their Coca-Colas times how many Coca-Colas they sold tells you the total revenue of selling Coca-Cola. Similarly, we have total cost, which is the market value of the inputs a firm uses in production. And total cost in this case equals average total cost times quantity. Now, profit is then determined by the difference between total revenue, i.e. how much a firm made, minus cost, i.e. how much a firm has spent. And we can rewrite this as pi for profit equals total revenue. Pi for profit equals total revenue minus total cost. Now, costs are a little trickier. So what goes into total cost? Well, there's two types of opportunity cost firms face. There's their explicit cost, which are the input costs that require an outlay of money by the firm. This is basically the things that a firm directly spends money on. These are the things that you would get a receipt for. So when they pay wages, they have a receipt, a explicit outlay of funds to pay someone's wages. However, firms also have implicit costs, input costs that do not require an outlay of money by the firm. Now, to explain the difference between these two, let's consider a brief example. If someone purchases, say, $300,000 in physical capital to make a factory, their opportunity cost would be the possible return, in this case, say a 5% interest rate, that those funds would have accumulated otherwise. So the firm has explicitly spent $300,000 on capital to make a factory. However, they've also implicitly spent 5% return they could have received by keeping that money saved in a bank account. So the explicit cost, purchasing physical capital, implicit cost, the interest they forwent in order to spend this money on physical capital. So the opportunity cost for purchasing the net capital in this is the lost return from just leaving the capital in an account, i.e. it would have been $15,000 in interest at a 5% interest rate. Even if this owner moves to borrowing $200,000 and using only $100,000 of her own money, an accountant would say that her cost is only the $10,000 in interest she is paying for the loan, while the economist would still insist there's $15,000 in opportunity cost, $10,000 for the loan, and $5,000 for the lost interest on $100,000 in savings. Now, let's pause for a moment. What does this mean? Simply put, imagine a situation in which someone takes out and borrows $200,000 in order to buy physical capital and puts $100,000 of their own money to purchase that physical capital. An accountant would look and say, oh, you spent $200,000 in loans, you spent $100,000 of money, and you have to pay an interest rate of 5% on the $200,000 you spent. Well, that's $10,000 in interest. So you have in total spent $310,000. That's an accountant would explain your costs. Economists would go, wait, no, you still gave up 5% interest rate return on the $100,000 you spent of your own money. So implicitly, there's an additional $5,000 in cost here that need to be added. So the breakdown is an accountant looks at explicitly what she has to pay money for, $200,000 loan, $100,000 of her own money on capital plus 5% interest rate on the $200,000 loan. The economist takes all those and factors in the $5,000 she lost by spending $100,000 of her own money instead of saving it. This gets us to the difference between economic profit versus accounting profit. Economic profit is total revenue minus total costs, including both explicit and implicit costs. And I apologize, for some reason, Blackboard is not reading my PowerPoints well. Accounting profit, by contrast, is simply the difference between total revenue and total explicit costs. So accountants look at how much money did you make and how much money did you directly spend. Economists look at how much money did you make, how much money did you spend, and how much money did you give up by spending the money that you spent. And so you can see this breakdown here as we zoom in. For an accountant, this is your total revenue, this is your total cost, and this gap between the total revenue and total cost is your profit, the green area. For the economist, however, you add in these implicit costs, which ultimately reduce your economic profit. To give you kind of a goofy example of this, Microsoft bought Minecraft for $1.8 billion. You might know Minecraft, it's a blocky little game. Why did Microsoft buy Minecraft for $1.8 billion? Well, the answer is they found that the return Minecraft would generate is roughly equivalent to the interest or other things they could have used that $1.8 billion for. And so ultimately, they found that Minecraft, and factoring in the implicit costs, Minecraft had a greater return and broke even than it would if they just sat $1.8 billion in a bank. Now, production is directly tied to the cost. The production function is simply the relationship between the quantity of inputs and the quantity of output of that good. But this relationship is determined by what we call the marginal product. And the marginal product is the increase in output that arises from an additional unit of input. So basically, the marginal product is for every single input, every individual input you put into your product, how much does your overall output change? So if you add one worker to baking cookies, and they make 50 cookies, the marginal product of that one worker is 50 cookies. However, there's another principle at play here, and this is the principle of diminishing marginal product. And this is the property whereby the marginal product of an input declines as the quantity of the input increases. This property is why the production function and the total cost curve are basically opposites of the same curve. And another way of thinking of diminishing marginal product is simply too many chefs in the kitchen. If you're like me, on Thanksgiving, there's a lot of great cooks in your family that want to go cook, make the meals, and you know if you're there, you're in the way, and it makes everything more difficult for everyone, and you may be able to clean like one fork, but that just gets in everyone's way and ultimately doesn't add much. Now, we can zoom into figure 2 to see an example of what a production function looks like. And what it shows us here is that we're using the example of baking cookies. What it shows us here is that as we hire workers, we are able to consistently increase our output. However, ultimately, the amount that we're increasing our output is going down based upon the number of workers we hire. So just to give you an example, why is it that we have this diminishing marginal product? Simply put, it's because typically we're assuming that this input is related to the same amount of capital. So just because we're hiring 6 bakers now to bake cookies, that doesn't change the fact we might only have 1 or 2 ovens. So even with all the help they're doing, that doesn't change the amount of time it takes to bake cookies. However, the fact that the more workers we add, we have to buy more equipment means that the total cost curve is also increasing at an increasing rate as our quantity of output increases. So basically what we're saying here is that we have initially dramatic increases in production, but we also will later on have dramatic increases in total cost as the increases in our product slow. Now, the various measures to cost, simply put, we have 2 basic forms of cost. The first is fixed costs. These are costs that do not vary with the quantity of output produced. Just to give you an easy example, we have rent, salaried employees, or electricity, for example, depending on your company, like Walmart. So Walmart, prior to COVID, used to be open 24 hours a day. That meant they spent the same amount on electricity every month, regardless of whether or not people were moving in and out and buying goods or how many goods were going out the store. Another good example of this is, again, think about rent. You have a set rent, right? The more people you add to the apartment, the less and less and less the rent gets per person. In contrast, variable costs are costs that do vary with the quantity of output produced. Inputs to produce an item, for example, leather for footballs, dough for cookies, coffee beans, hourly laborers. These are things that as you make more output, the prices and cost have to go up. A good example, if we want to go back to renting an apartment, your water bill is a variable cost. The more water you use, the more you pay. Now, average and marginal cost are extensions of these costs. So average total cost is simply the total cost divided by the quantity of output. Simple enough. Total cost equals fixed cost plus variable cost. So what that means is the average fixed cost must simply mean the total fixed cost divided by quantity, and average variable cost must equal total variable cost divided by quantity. Similarly, marginal cost looks much like marginal product. It is simply the change in total cost based upon the change in quantity of output. Now, why do we have this distinction? Simply put, the average cost tells us the typical unit of output if total cost is divided evenly over all the units produced. Marginal cost tells us the increase in total cost that arises from producing an additional unit of output. Now, cost curves and their shapes. Cost curves typically the cost curves for a typical firm are typically the average total cost, the average cost, the average variable cost, and the marginal cost. Now, there's a few things I want you to note here. First off, we have a rising marginal cost. Basically, what that's telling us is the additional adding of any additional unit of input, its cost is rising at an increasing rate. Similarly, you have a U-shaped average total cost curve, and we'll explain in a moment why the U-shaped average total cost curve exists. Think about the marginal cost curve, and let's zoom in here. Think about the marginal cost curve. What this is telling us is the change in total cost based upon an additional unit of output. So, as long as the marginal cost is below the average total cost, that means the average should be going down, right? The reason that is because the marginal cost, so for example, say the marginal cost of making an additional cookie is 50 cents, and the average total cost prior to making that cookie was dollars, that means that additional cookie at 50 cents must be bringing down the average total cost. However, once marginal cost equals average total cost, this is the point at which average total cost is minimized. That means it can't go down any further. Why is that? Because if the average total cost for making a cookie is $1.50 and the marginal cost of making an additional cookie is $1.50, then that means the average hasn't changed. That means the average total cost remains the same by adding one more cookie since it's made at the same price as the average total cost. However, the minute that marginal cost goes above average total cost, this is when the average total cost starts increasing. So if we make one more cookie and that cookie costs $2 to make, and we have an average total cost of $1.75, that last cookie at $2 means we have increased our average total cost. What this means, though, is that the efficient scale can be achieved when marginal cost equals average total cost. Simply put, the efficient scale is the quantity of output that minimizes average total cost. Now, just a brief summary of how to interpret these. Marginal cost eventually rises with the quantity of output. Note that average total cost is U-shaped because as marginal cost is lower than the average total cost goes down. And when marginal cost crosses average total cost, it increases. And so marginal cost must then cross the average total cost at the minimum average total cost, or the efficient scale. One more thing to note here. The marginal cost where it intersects average variable cost, that is also the cost minimization point for average variable cost. And average variable cost will increase once marginal cost exceeds it. But there's one last thing I want to note here. Notice that the average fixed cost basically approaches zero the more and more you produce. The reason average fixed cost approaches zero the more you produce is because the average fixed cost, right, does not change. So if your rent is $1,000 a month and it's just you paying it, then the average fixed cost is $1,000. However, if two people live in the apartment, the average fixed cost is $500. If three people live in the apartment, then the average fixed cost goes to $330, and so on and so on and so on. So that's why average fixed cost approaches zero and is constantly decreasing as quantity increases. Now, one thing to note here, we have cost in the short run and in the long run, and the relationship between short run and long run ATC looks something like this. If you have a small factory, it's very difficult to reach economies of scale. And economies of scale are the property whereby long run average total cost falls as the quantity of it increases. So average total cost in the short run with a small factory means that you have to produce not at the quantity minimizing point, but rather at a higher average total cost. Simply put, a small firm can't get the volume required to be efficient. However, in the long run, a larger firm can establish this economies of scale and minimize their average total cost. Once this point has been achieved, we get what we call constant returns to scale, and that's where the average total cost stays the same across the board, no matter how much you're selling. Just to give you an example, Walmart is a firm that is very, very good at assuring constant returns to scale. However, notice that in the long run, factories get so large, and due to the diminishing marginal product and rising production costs, ultimately larger firms hit a point that's called diseconomies of scale, and this occurs in the long run. In the long run, average total cost must start to increase. And this means that the property is whereby long run average total cost rises as the quantity of output increases. So basically, diseconomies of scale tells us that larger firms ultimately cannot keep these efficiencies and constant returns to scale ensured, meaning as their quantity increases, so too does their average total cost. To give you an example of firms where this is a significant issue, think of things like J.C. Penney's, a firm going out of business, Hertz. Basically, this is an industry in which it's difficult to keep up with the scope at an effective cost price. Now, for conclusion, just review. This is a great table to familiarize yourself with because it's a good summary of all the equations and the mathematical description we have for them. Simply put, we have explicit costs that require an outlay of money by the firm, implicit costs that do not require an outlay of money by the firm, fixed costs that do not vary with the quantity of output produced, and we can denote this as FC. Variable costs, which are costs that vary with the quantity of output produced, which we can denote as VC. Total cost, we can calculate this by simply adding fixed cost plus variable cost. Average fixed cost then is simply the fixed cost divided by the total quantity we've produced. And remember, the average fixed cost approaches zero the more quantity goes up. Average variable cost, which is variable cost divided by the quantity, simply put. And notice that this is one that fluctuates depending on its relation to marginal cost. Average total cost similarly acts as average variable cost does, but it is the total cost divided by the quantity. Now, one more quick way to consider how you can write average total cost, you can also write average total cost as average fixed cost plus average variable cost. Similarly put, marginal cost then is the increase in total cost that arises from extra unit production, and it is simply the change in total cost based on the Now, that's for y'all today. Again, this chapter has been a brief introduction into chapter 13 and the types of costs that firms incur. And as we'll see in next chapter, we'll see how these costs help firms decide how much they're going to produce and ultimately explain why the law of supply ties directly higher prices to a higher quantity supplied. Till next time, take care.